Ladies and gentlemen, good day and welcome to Karnataka Bank's Q4 FY23 audited earnings conference call hosted by Karnataka Bank. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star then 0 on your touchtone telephone. Please note that this conference is being recorded. On behalf of Karnataka Bank, today's call is attended by Mr. Shekhar Rao, Managing Director and Chief Executive Officer Interim, Mr. Balachandra YV, Chief Operating Officer, Mr. Gokul Das Pai, Chief Business Officer, and Mr. Abhishek S. Bagchi, Chief Financial Officer. I now hand the conference over to Mr. Shekhar Rao, MD and CEO Interim from Karnataka Bank, to give his opening remarks before the Q&A session. Thank you, and over to you, sir.
Thank you, Melissa. Hi, everyone. Thank you for sparing time for this call. I'll start with my introductory remarks. Very good evening and welcome you all to this conference call of the results for Karnataka Bank for the quarter and year ended 31st March 2023. I am right now the interim MD and CEO, and my other colleagues have joined this call, whom Melissa just introduced. I assumed charge as the ED of the bank on 1st February, and since mid-April have been functioning as the interim CEO. As you know, the bank has identified a new MD and CEO. It is Mr. Sri Krishnan Harihara Sharma. He comes with the same has been approved by RBI. Prior to his selection for Karnataka Bank, he was with Jio Payments Bank. He was an entrepreneur, and he was part of the founding team at HDFC. And he comes with impeccable credentials. So we are delighted to welcome him on board. This is an important change for the bank, in the sense that for the first time we will have a lateral with industry experience joining the bank as the Managing Director and CEO. Moving on to the financials and the year that went by. As you all are aware, the year that went by witnessed one of the economic history's sharpest monetary tightening and steepest inflation. Central banks across the world responded with aggressive rate hikes. India was no different. US was leading the way with around 475 basis points. The Indian Central Bank RBI raised repo by 250 basis points. This benefited and tightened operations for banks, so there was a plus and minus. Apart from that, the focus for many banks, including our bank, has been digitization, and going forward we expect that to accelerate. The concerns largely on the economic front are probably some job displacement due to automation, digitization, etc., risks associated with climate change, rise of the gig economy and remote work. So these are some emerging trends, but too early to call on it right now. We made significant strides on our financial performance, and for the first time, bank has declared a net profit which is in 4 figures. It is 1180 crores, which is almost 100 crores per month. Coincidentally, we are celebrating the centenary year this year, and this I believe is the greatest gratitude we can offer to our founding fathers, and we are very happy to announce this result. On various business strategies, some of them that will pan out, and that is we've already laid the foundation, is our sharper focus to retail lending, portfolio optimization, digital origination. These are areas that we've laid the foundation and we'll build on it going forward. The Q4 net profit was around 353.75 crores, and year-on-year growth of 171.39%. The last year in the same quarter it was 130.34. Important point to note is other income excluding depreciation and trading profit was also at 1150 crores. This also had a healthy 15% increase over the last year. Operating profit during the quarter has shown a growth rate of 80.41%. Net interest income during the quarter went up 31%, and for the full year on a 27.86%. NIM, as you are aware, we have a story going there. It's improved to 3.87%, which was as against 3.25% for the quarter ended March 22. For the full year, it went up from 3.18 to 3.70%, a healthy increase of 52 basis. ROA during the quarter went up from 0.56 to a record high of 1.4. For the full year, it stood at 1.21%. ROE went up from 7.42 to 17.61. Gross NPA is at 2292.91, whereas it was 2250.82 crores. This was primarily account of some accelerated provisioning and accelerated recognizing of NPAs that we do for. Since we relied on the strength of our balance sheet, which was looking very healthy in Q4, to make this accelerated provisioning. In percentage terms, it's down to 3.74 from 3.90%. But this accelerated provisioning is an one-time exercise, and it will add to the health of the bank. As far as net NPA, it has come down to 1021 from 1376.97, a healthy reduction of 25.83 basis points. Coming to slippage ratio, last year March it was 3.11%. This year it's 3.31. The reason which I mentioned is as before, because of the accelerated calls that we took. Provision coverage ratio is a healthy 81% as against 73.47 last year. Cost to income has moderated to 47.414 vis-a-vis 2.57%. The interesting point to note on the accelerated provisions is out of the 328.82 crores of provisioning that we did during the quarter, almost 249.14 is the accelerated provision, and the balance is as per IRAC norms. Overall business turnover reached a new high of 147 lakhs, 319.63 crores, just short of 150 lakhs, 1.5 lakh crores, at a growth rate of 7.40%. The other point here is while deposits grew at 8.68%, we did not see significant loss or movement of deposits from CASA to term deposits, which was observed in the market. So we were able to protect our CASA franchise. In fact, our SB account franchise, the cost of deposit is the most competitive in the industry at around 2.94%. CD ratio has marginally decreased to 69% from 71%. But this was a conscious call that we had taken. In the increasing interest rate scenario, we were able to, like I said, retain the CASA market share. Yield on advances during the full year has improved by 57 bits, up from 8.84 to 9.41. The cost of deposit for the last year is 4.66 to 4.62. The other good news is our board has proposed a dividend of 50%. This is subject to shareholder approval. And I have every reason to believe that at this stage, the stage is set for an impressive takeoff of the year, so as to ensure business excellence during FY23-24, especially in the area of growth in advances, which could be ahead of industry growth rates. We would also see significant improvement in asset quality. Technology initiatives are being strengthened further. We've seen our technology budget for the upcoming year go up by almost 80%. Clearly, while there have been a lot of positive outcomes. There are some learnings as well. The important points here to recognize, important point here is to recognize the same and start working on these and clearly start demonstrating our intent. In this regard, thought of sharing some of the major initiatives already rolled out. With our org structure, which I mentioned in our in the media interview today morning as well, is realigned. We have made it more linear with heightened focus on retail, branch banking, and product management. The product management will, of course, support the sales vertical. We have benchmarked our gold loan and housing loan products to make it more competitive in terms of features and pricing as well. We are already seeing green shoots of that. We are improving our underwriting capabilities, both in terms of efficiency and capacity. We are increasing the number of retail hubs from 3 to 5, and which will eventually go up to 8. With this beginning, the other promise that I want to make to all of you is instead of keeping these interactions as an event-based once in a year, we will increase our interaction and reach out to all of you, and we will seek feedback from you on a continuous basis. With this, I kind of open the floor. Over to you, Melissa.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If your questions have been answered and you wish to withdraw yourself from the queue, you may enter star and 2. Participants are requested to use handsets while asking a question. Participants are also requested to limit their questions to 2 during the initial round. For additional questions, you can rejoin the queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Sushil Choksey from Indus Equity Advisors. Please go ahead.
Good evening. Congratulations to Karnataka Bank on centenary celebration and the performance which you achieved in the FY23. Shekhar, referring to the comments which you made in media and right now, of your joining the bank in this year and the new MD coming in, what is the broader vision of Karnataka Bank in terms of perspective which you would like to see over a period of 1 decade or 2 decades? Because it's one bank which has never lost money in any of the financial years of last 100.
Thank you for your comments, Sushil, and thank you for joining the call. We're not looking up for a decade, but very clearly, we have a very robust network. We are a recognized brand in Karnataka. We are a recognized brand in markets that we operate in. We have significant presence in places like, apart from Karnataka, places like Mumbai, Delhi, Hyderabad, Chennai, and so there's a lot of customer goodwill. And riding on this, we would like to increase our retail focus. Here, we've taken a lot of steps already. One is the org structure to make it more retail-centric, the classical structure of having a retail advances vertical, a branch banking vertical, so that we leverage our network of 900 plus branches. We are also improving our credit underwriting flow so that the turnaround times improve. Already 85% of the loans that we originate are digitally underwritten. We would further debug this process to ensure that the customer experience improves. We also are improving capacity by adding 2 more credit hubs immediately, retail credit hubs, which will process loans up to values of 2.5 crores. This will go up to 8. Given all this capacity enhancement and the investment that we are making in technology, we see we hope to see a significant uptick in our retail market share. Also, another important initiative that we have taken is with the help of E&Y, we are setting up a analytics center of excellence. So we have a large customer base of 1.3 million customers. In fact, if you consider a bankable population of 458 million, 1 out of 40 customers actually bank with Karnataka Bank. So this analytics center, we are looking at using data analytics to increase understanding of our customers, propensity modeling for pre-approved loans, cross-selling. So our current product penetration is somewhere between 1.5 to 2. We plan to improve it further. So these are some of the thoughts and strategies that we are rolling out for the next 3 years.
Okay, now a follow-up question is couple of points which you highlighted. So what is your expectation on NIM, cost of funds, ROA, ROE for coming years? And where do you, what kind of provisions have you taken, or you have taken some provisions for slippages, and what are the provision for mark-to-market and treasury?
So you'll see some moderation in NIMs, which will reflect in NIA. However, we are also positive that this will get compensated by change of product mix and business growth and other income as well. ROAs and ROEs will be marginally higher than current levels. As you see, our provisioning already has reached 80% plus. Our NPA provisioning is also fairly healthy. But we will continue to provide as and when required, and we would take it up to, it will be somewhere between 81 to 85 as we progress through the year. We also have seen a significant reduction in our restructured book, which has helped us as well. And as a combination of restructured and related accounts, close to 90% of the restructured accounts are repaying their loans, which is again a source of comfort. So overall, also on last year, due to the rising interest rate scenario, there was not much of opportunity for trading profits, but already we are seeing green shoots of that in Q1 itself. As we speak, we have a depreciation benefit, and that would be one of the stories that will pan out during the current year. But that will not be unique to us. In fact, most banks would benefit.
Okay, but if you can highlight, as what you said, some accelerated provision was made in the quarter, and what was mark-to-market loss in the
for example, the mark-to-market last year was around 180 plus crores. So that is already captured in the balance sheet, and this year we'll see an improvement there and right back there. Accelerated provision, again, the number that I have handy is for Q4. We did out of the 328.82 crores, 249.14 was the accelerated provision that we did. So clearly, we've used the health of balance sheet to make the right calls in terms of provisioning. And
what are the reason for this accelerated provision?
So there are multiple, wherever we identified some stressed accounts, also some places where the FSV changes, post sale value change happened. So combination of couple of factors, we took the call and took these additional made these additional provisions.
My last question: what kind of credit growth aspiration? The industry is talking of 12 to 14% across private or public sector banks. What would be an aspirational number at Karnataka Bank for the year?
So touch wood, we would beat the industry growth rate this year.
Okay, I'll join back in the queue as and when it's required. Thank you.
Thank you. Thank you.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Sarvesh Gupta from Maximal Capital. Please go ahead. Mr. Gupta, your line has been unmuted. Please proceed.
Yeah, good afternoon and thanks for taking my questions. So on accelerated provisions, as a follow-up, so basically you are saying that out of the 330 odd crore provisions, 250 was sort of more than what we were required to take, and we took it because we had healthy profitability for the year and the quarter?
Yes, Yes, that would be a right assessment of that. So close to 75 crores as per IRAC and balance on account of accelerated provision on.
So ideally, these will not recur in the coming years, this 250 crores?
Yes, very clearly these will not recur in the coming years. So, and these are one-offs. Whenever you see an opportunity, you take these measures as a measure of prudential measure, basically, prudent measure.
And on our restructured book, so that came down from, let's say, 4,200 crore of standard restructured, which was there last year. Now we have around, I think, 2,500 crore odd.
Yeah.
And this reduction also contributed to, let's say, 800 crore of gross NPA out of the 1,800 crores of the slippage. So further, how much can we expect this year against this 800 which has come from this book?
So this book, like I said, almost 90% of this restructured book has been are repaying, and only 10%, actually 8% is where we see stress. So I would peg that number somewhere around say 200 crores, where we will see enhanced measures. But the good thing is most of our portfolio are backed by very bankable securities. So we are confident of recovery in that piece as well. Also, the thing is why, as you know, this 2570 is based on the RBI classification, which includes related accounts as well. So the core restructured book is actually lower than this.
Okay. So basically what you are saying that so if in FY22 we had an opening balance of, let's say, 4,000 crore and 20% of that slipped into NPA, right? 800 crores. Now out of the remaining 2,500 crore, you are saying 10% can slip.
See, actually we've seen 630 crores is the number that has slipped into NPA out of this, and 630.51 to be exact. And this was on the back of the COVID based fallout. And we clearly see an improvement in this portfolio. And what we are predicting, we are fairly confident to that the outcome will be very close to what we are saying right now.
So 90% is well taken care of, because there is an element of SMA2 also in the current standard restructured also, right? So you feel that only 10% will slip from here?
The SMA2, so there are two categories in that. One is three categories actually. Account is overflow, second account paying regularly, and third accounts paying with a little delay. So the combination of all three is close to 90%, and the rest is around 8%. So okay.
And the other thing, sir, is the growth on the overall credit side. So I think this year we did only 5-6%. And even if I just look at the retail, which is where we were supposed to grow, that also is at 11-12%. So both are lower than the industry growth rates significantly, overall as well as the retail piece. So what gives us the confidence that we will be able to match to the industry growth on an overall number, because we have not been able to match even the retail growth number for this year compared to the industry and most other players?
Yeah, two, three points to note here. First, we were tracking along around 12% growth till about Q3. We deliberately took a call in Q4 to slow down, basically retire advances which had yields lower than GSEC yields. So there was an opportunity because of the health of the balance sheet to take that call, and we did take that call. Yes, it did reflect negatively on the growth rates, but it helped us improve the bottom line because this money actually got redeployed in instruments which were yielding higher. Point two is we clearly understand now as to what are the engines of retail growth. Our pricing and the product construct was slightly out of tune with current market trends. Gold loan, for example, we have completely redone the product. It is simplified. We didn't have a bullet loan product. We have introduced the bullet loan product. Our home loan prices was out of sync with market rate. Now we have a headline home loan pricing of 8.75% or somebody with a CIBIL score of greater than 800. We have STP processing through our digital journey. We are increasing our capacity in terms of ability to underwrite and TAT. We have significant presence in most of our markets in the mid-corporate lending to the builder and promoter segment. But we have never leveraged this for builder tie-ups on the retail side. We are going through a very calibrated action in this where we are, in fact, over the quarter itself, we have more than 300 properties in Bangalore being assessed and valued, pre-approved by our bank. So all these measures, the structured approach, we also are putting close to 200 feet on street for home loans. In gold loans, we are also tying up with an agency called Sahi Bandhu, which currently distributes around 500 crores for that additional reach. So a variety of measures gives us this confidence that clearly we would be able to accelerate on the retail front. And we have demonstrated this in earlier years. In fact, when we had a fairly competitive pricing, our home loan and retail portfolios have grown ahead of market rates.
Okay. Sir, on your ROA, so your pre-tax ROA might have increased by, let's say, 90 basis points or something like that for this year, and the NIM alone contributed to more than half of it. So NIM expanded by less point. So how much of a mean reversion is possible in your NIM going forward, especially as we see that your cost of deposits have actually gone down this year by 4 basis points, even in a year when interest rates are moving up. And now that same benefit you will not get when the interest rates move down, if they were to move down. But you are also guiding for increase of ROA instead of decrease. But most of the increase of ROA has actually come from your NIM. So what is that conservative, or how should we take your ROA guidance and including the NIM guidance?
So, like I said, ROA guidelines, we would be trending around current levels and maybe a marginal increase, but largely trending around current levels. That's what I mentioned. On NIMs, I said we won't breach the current year levels. It will be range bound between 3.5 to 3.70%. Our compression NIMs will be compensated by increase by our growth and also change in product mix. We also would see some, in fact, the treasury part of it will start kicking in this year, and you already have seen signs of it. Both trading revenue, profit would improve, and that would keep our ROAs protected to a large extent. Maybe factors contributing to ROA would slightly alter, but the output will remain around these levels.
And NIM should trend in a similar range as where we are right now at 3.87?
Yeah, I mentioned, no, I said it will be range bound between, on the optimistic side, to around 3.7, on the pessimistic side, 3.5.
Okay. And what is your estimated number on cost to income and the OPEX side, sir?
Cost to income, we would see one very slight marginal increase. There will be some provisions on account of wage revision. and there will be some technology spends, most of which is budgeted for and accounted for. Some of the capex have already been incurred. So you will see a 1 to 1.5% range on either side of current OPEX levels. It could be in that range, +1 to -1, I would say.
Thank you, sir. Thank you. All the best.
Thank you. We have the next question from the line of Manish Dhariwal from Fiducia Capital. Please go ahead. Mr. Dhariwal, your line has been unmuted. Please proceed.
Yeah, thank you. Am I audible?
Yes, please go ahead.
Yeah, thank you very much. So there are a lot of reasons for celebration at Karnataka Bank. So it's a centenary year. Then the management change, and you come up with fantastic numbers. So congratulations for all of that. Now, my whole concern or the question is surrounding the growth, which is not coming at a high credit loss. So while Karnataka Bank is a good brand and surrounding Karnataka and other places, but then I think the other banks also are claiming the same, and the confidence that the management has expressed about growing higher than the industry is something that if you could maybe give more color, and what do we understand about the credit costs going ahead? How would one look at that? So growth in sync with the emerging credit costs.
Hi Manish. Thank you for your compliment. I believe your question has two parts. One is about your growth concerns, and second on the credit cost. I think so. I lastly answered what all we are doing on the retail credit growth side, a series of measures. So including product rejig, organization structure, capacity building, investing in technology, so on and so forth, which is pretty much a standard playbook. We clearly enjoy considerable goodwill in the market that we operate in, and we will leverage. We already have 900 strong branch network and a good tooth-to-tail ratio of greater than 85%, which means a large percentage of our employees operate out of branches. We leverage this presence both in terms of people and infrastructure for our growth. So the specific initiatives I already detailed in my earlier question.
Yeah.
On the what do you call credit cost, there was a one-time aberration in Q4 on account of accelerated provisioning and the GNPA calls that we took. But otherwise, going forward, it will be around the same level that we operated in the other quarters. So we would see it at an average of around anywhere between 0.25 to 0.30.
Okay. See, I thank you for your reply. See, I was talking also in the line of what recent communication has come out from the RBI saying that there has been some smart way of hiding NPAs and all that. So basically, see, the level at which retail is getting credit, ultimately the pain has to come. So and see, like there are some institutions who have been doing retail for a long time, whereas some institutions like ours has recently kind of started focusing on the retail side. So how is it that we are kind of ensuring that it doesn't come to bite us, so maybe a year or two ahead? So especially in the line of the
I'm not sure whether I got the first part of your question. You alluded to some concealing of NPAs and RBI direction on that. So in fact, we have gone on the other extreme, that we have gone ahead and disclosed, and as a measure of operating caution, we have also taken some prudent measure of accelerated provisioning, etc. On the second part of let me just elaborate on what's panning out in Karnataka. With the bank consolidation, etc., that happened around a few years back, there are just two truly Karnataka domicile bank. One is Canara and the other is Karnataka Bank. And given this 100-year legacy, customer goodwill, we see a fair bit of kind of movement of business and consolidation in our direction. So we also, one is the pan-India plans that we spoke about, the retail rollout, etc. The second is the Karnataka specific bank of choice. In fact, we'll be rolling out a campaign which talks about Namma Bank, which says Apna Bank, and where we'll be riding on the sentiments of being a bank of choice in Karnataka. So these and other things, other measures that we roll out, we hope to kind of, we were fairly confident that we will be able to regain our pride of place as the bank of choice in Karnataka.
Thank you and all the very best. Hello?
Thank you.
Thank you, Manish. Thank you.
Thank you. We have the next question from the line of Chintan Shah from ICICI Securities. Please go ahead. Mr. Chintan Shah, please go ahead. Your line has been unmuted.
Hello. Thank you for the opportunity and congratulations on a good set of numbers. 1-2 questions from my end. So firstly, in terms of our loan book, in terms of fixed and floating, how much percentage of our book would be fixed in nature and floating? If you could help with those numbers.
So I believe, hi Chintan, again, thank you for your compliment. So you wanted to understand what is the percentage of floating versus fixed.
Right.
So almost 79% of our loans are linked to floating. So I can give you the base rate linked around 1, HCLR linked 22%, EBLR linked is the majority, around 56%, T-bill rate 1.28 and fixed rate otherwise is 21%.
21%. Okay, sure. So got it. And so, sir, in terms of, as we anticipated, that with the decline in the interest rates going ahead, there could be some pressure on the NIM. So this is in terms of our borrowing side, so how much hike are we expected? Any tentative hike expected in the borrowing cost from here on? Any chances, any plans of raising the deposit rate further from here on, or are we at the peak rate as of now, considering the current RBI rate?
I think so. Interest rates would moderate now. We won't see the 7.7, 7.8 kind of rates that we had earlier. We would see we are at 7.3 as our headline rate for a year. You would see a plus or minus of 5-10 bits, but not major changes apart from that. That will be based on opportunity and need for liquidity. Right now, our liquidity position is comfortable.
Sure. So this is on the growth side, so sir, it will largely be driven by the retail piece, right? If I'm not wrong.
Yeah, credit growth will be strategically on the retail piece, but we may take tactical calls as and when required on the corporate and mid-corporate piece as well.
Sure. And sir, you mentioned 1 to 1.5% plus minus on the OPEX. So that was OPEX to assets ratio, right? Or cost to income?
Cost to income.
Oh, okay. Cost to income. Yeah, okay. Sure, got it. And also on the recovery in TWO, so I think we have seen a quite steep recovery in TWO for us as well as for the system during this year. So what is the expectation of this going there? So is this recovery in return of accounts expected in the next year? I think any ballpark number which you're expecting for that?
So our TWO last year was, the year before, the previous fiscal was around 246. Last year was 283. We have a TWO book of 3043. We would see TWO recovery around current year level. I mean the previous year level is what we are seeing. So anywhere between 250 to 275 would be a good estimate.
Okay, 250 to 275 crore. Sure, sir. Sure, sir. I think that's it from my side. Thank you and all the best.
Thank you.
Yeah.
Thanks, Chetan. Thank you.
Thanks.
Thank you. We have the next question from the line of Jay Mundra from ICICI Securities. Please go ahead.
Yeah, hi Shekhar. Good evening and thanks for the opportunity. Sir, I wanted to get your views on the retail strategy, right? So if you can elaborate on that, you have said that retail is going to be the key driver for growth, and that is where you want to, sort of increase the product per customer as well. You clearly have a retail franchise in terms of customers, but I wanted to check, what is your, let's say, key target segment? Is it going to be self-employed segment, or you have any vision for, let's say, prime salaried customers also? And then the associated question would be that, what is it that probably will give us the right to win in this segment? And maybe the last thing is that usually retail comes with a higher OPEX, at least in the initial phase. So where are we in that investment phase with respect to retail business?
Yeah. So in fact, I did elaborate on the retail strategy earlier in the fall. That was the first question Mr. Sushil asked. But nevertheless, I'll elaborate, detail it out again. So in fact, so any retail strategy is a combination of pricing, distribution, speed as in TAT, and we would be what we call customer subsegment agnostic. In the sense, if we are able to price our loans attractively, if we are able to underwrite quickly, and if the overall features are customer friendly, we would already see significant low hanging fruit, because we have something like 13 million customers, 70% of which are active customers, and right now we have our customers banking with others or going to other banks for some of these products. So clearly these are the first measures that we will take. Having said which, we are also improving our salary proposition. Earlier, the salary proposition was just a standalone savings account. We, like most banks, we are coming out with a bundled salary product, which will be a combination of a savings account, locker fee discount, special pricing on asset products, etc. So clearly, but that, as you would be well aware, the salary franchise to build will take some time. So initially, we will be pretty much sub-segment agnostic, and we will ride the opportunity created by improvements on the three fronts that I earlier mentioned. As regards products, we are looking at home loans, we are looking at gold loans, we are also looking at agri with tie-ups. For example, we have a couple of large alliances that we have put in place, which will see our agri business also scale up. So these are areas where we will see significant action going forward.
Right, sir. And sir, in terms of investment in retail, right? So all the retail is high touch, lower ticket size relative to corporate SME. and more effort involved. So where are we in terms of this investment phase, or is it more likely that the OPEX growth will be at least for the next 6 to 12 months will be much higher than the loan growth as you build the processes, systems, etc.?
So yeah, that's a very good question. In fact, it helps me highlight a point. So we already have an under-leveraged franchise, is my belief. We have 950 branches, and we have created those retail hubs, which we are redistributing. The existing 3 hubs will be redistributed to 5, and then we'll go to 8. This will be operating out of our existing regional offices, so we don't see additional cost in being incurred there. We had undertaken a what we call transformation journey with the help of BCG called KBL Vikas, where most of the loan underwriting became digital. So the pipes are in place, the scoring models are in place, the underwriting team is in place. So the point is the entire OPEX has already been incurred, and it's a kind of under-leveraged franchise, and we'll clearly do those product, process, policy kind of improvements. Also, the standard playbook, we have created an associate company called KBL Services, through which we will be employing feet on street for builder tie-ups and implants there, for implants at automobile showrooms. We are also tying up with, like I said, a firm called Saribandhu for gold loan origination. We have onboarded a couple of large BCs, like say for example SKDRDP, who has a book of around 60,000 crores. We are picking up their, we are looking forward to that partnership very eagerly. So we won't see OPEX increase. Yeah, there will be some investment in terms of having those feet on street, those runner boys, etc. But they all operate largely on a what you call high variable, low fixed kind of model, and it will be outcome linked.
Right. And sir, any talent gap that you see at the current juncture for all these initiatives to play out? Have you identified any talent gap in the existing mid management level? Or you intend to carry?
Really, we did this org structure rejig to make it more linear. So we created those. So you would be familiar coming from the ICICI Bank and that group kind of, where you had the structures of having branch banking, retail assets. So our structure is aligned to that product verticals. So the talent gaps that we have clearly are for roles middle and senior in technology, transaction banking, also in product management, and a bit in risk as well. So these are areas where which we will supplement through talent through lateral hiring.
Right. And lastly, on commercial slash SME, MSME piece, right? So retail you elaborated, corporate you had said that the stance will be more opportunistic. On commercial slash SME, how are you seeing things panning out? Because large private banks, they have become very aggressive in this space. So what kind of let's say priorities or aspirations you have in SME slash commercial segment?
We already have a very good presence in the MSME stroke SME space. In fact, we have 30% of our book is there. And see here, this is one area where probably the old gen private sector banks score over modern private sector banks, because this product and segment is highly relationship centric. The way new gen private sector banks operate is a large part of these businesses are centralized, and branches are agnostic to the MSME customer. They are only points of transactions or service. while as in our model, the MSME customer is owned by the branch apart from just being serviced by the branch. So this gives a great deal of comfort to the MSME. And the other thing is, due to our legacy, which is a plus, a large percentage of our branch staff and branch managers are able to understand credit and do that basic underwriting as well. They are comfortable writing camp sheets, etc. So this is clearly one of our core strengths. And we are recognized for that. So we will kind of leverage this for bettering our position in MSME as well. There, one clear area of improvement is our pricing structures and the product proposition. So we are creating products for the contractor segment or sector-specific products, which will help us kind of consolidate our position in this MSME space.
Right. No, I understand, sir. We have a very good legacy and a very decent, let's say, presence in the SME space. I wanted to check, like you said, retail is going to be the key driver. Would the same hold true for SME also, or yeah? So that is what I wanted to check.
So I would like to answer it like this. MSME is already it's a kind of cash cow, and while as retail would be the star. So that's how I would like to place it. So we will of course continue to put our energies in MSME. That's a space that we understand well. But retail is something where, given our franchise and presence, we would want to what we call scale and hence the increased intensity there.
Sure. Yeah, that is all from my side, sir. Thank you and all the best.
Thank you so much. Thank you for being on the call.
Thank you. We have the next question from the line of Hitendra Gupta from Systematic Shares. Please go ahead.
Good. Congratulations for the good set of numbers. I have just two questions. One is with regard to the appointment of Mr. Sharma. So when he will be assuming the charge?
Yeah. Hi, Hitendra. Thank you. He'll be assuming charge on 9th of June. So in fact, the selection was done almost a couple of months or a little more than that back. And as you know, there's a process of RBI approval which has been received, and he'll be taking charge on 9th of June.
Okay, so his involvement right now is nothing as of now.
As of now, of course, yeah.
Yeah. And my other question is with regard to the loan growth. The average loan ticket size. So what is the average ticket size for the different segments like retail, mid corporate, and large corporates?
So retail, in fact, retail, I would say less than. So our classification of retail on that, including agri, is around 10 lakhs, 9.67 lakhs. That is including agri. Mid corporate would be around 16.13 crores. Large corporate would be around 150 to 170 crores.
Okay. So no, I was referring to your slide, and on the slide number 21, it was retail was 9.96 crores. So I was just wondering whether it is 9.96 crores or 9.969.
It is 0.10 crores. So
0.10 crores, yeah. And what kind of a growth can we expect in terms of NII going forward?
So like NII, so NIM, I have said the range, etc. NII would be aligned to the what you call top line predictions that we have predicted.
What would be that, sir?
It will be ahead of market rates currently, anywhere between a comfortable guess would be around 15 to 18% increase in NII.
Okay. That's it from my side. Thank you, sir.
So much.
Thank you. We have the next question from the line of Rakesh Kumar from B&K Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity, sir. So the first question is with respect to, total cash balances, the income on the cash balances. So RBI, I understand there is no interest income. But we have total, on an average, we are holding close to around 5,500 crore. And our income is slightly low. So other than CRR, are we not, earning anything on call money market or other markets, money markets?
Oh, of course, we are earning on call money. We have excess SLR. So while the cash with RBI is strictly as per requirements, the balance is deployed in suitable money market instruments. And currently we do have excess SLR, which we recognize.
No, so what is the total income that we have accrued this quarter from, cash balances?
Let me get back to you on this as we go through the other questions. I'll very quickly get back to you on the income from cash balances.
Because for the year I see it is 1.58 crore for this FY23, and for this quarter it is 0.2 crore. So okay, so maybe we can discuss that.
Yeah, I'll come back to that question very soon. Yeah.
Sure, sir. Secondly, so, if we can give 2-3 reasons why, there is a close to around 40 bits rise in the yield on advances this quarter. So, what is the change that we have seen in the loan portfolio mix that has led to this kind of, jump? If we see, as you mentioned, the loan breakup thing on the, floating and fixed and all those things. So, based on that, yield movements would not have been, close to 40 bips this quarter. So if you can explain the reason why this, rise in yield was there.
Hello. Hi. So,
yes, sir.
So on the improvement in yield, it is primarily on account of, like I said, in Q4 we took this decision to retire some low yielding deposits. This was almost advances. This is on account of which we saw a slowdown in our advances growth also, and these were at prices below even the T-bill rates. This had a consequent impact on the yields going up. But this, as I said, was a one-time measure where we had to kind of take the call at some point of time. And the choice was better between carrying these in our book and thereby impacting the NIM or retiring them and deploying it in better yielding instruments. Like for example, in March 23, the composition that you asked about, currently retail plus agri is at around 50%, mid corporate is 30%, large corporate is around 20%. This in December 22 was 48, 29, and 23, and that had a consequent impact on our NIMs.
Mm-hmm. Okay. And during the call, if you can just highlight the reason for this, the yield on the cash balances other than CRR.
I'll quickly get back to you.
Thank you, sir. That's it from our side, sir. Thank you.
Thank you. We have the next question from the line of Saket Kapoor from Kapoor & Company. Please go ahead.
Namaskar, sir, and thank you for the opportunity. Sir, firstly, if you could give us some understanding on the ROA part. So we exited Q4 with an ROA of 1.4, and our average for FY23 was 1.21. So what should be the trajectory that we should work out for ROA? I think so for NIMs you have mentioned it will be the band of 3.5 to 3.7.
So ROA trajectory also, I think so I answered. It will be, we would see it pan out around the current year level with a marginal increase on the optimistic side. So we don't see any significant spurt in ROA going forward.
So this 1.2 will be maintained. 1.4 was an anomaly for the fourth quarter.
Yes, it will be. I earlier also during the call gave a number and we will be around that level.
1.2.
Yeah, slightly more than 1.2. Yeah.
Okay, sir. And for the capital raising part, sir, currently we have a CRAR of about at 17.45. So what is the outlook on the capital raising exercise? Anything you would like to share?
So on the capital raising, it is we are comfortable right now, but we would be evaluating this based on our growth trajectory. The next capital raise that we will the capital raising that we will do will take into account two major factors. One is the capital required to support our growth aspirations, and second, any change in the accounting standards related to ECL, etc., that you are aware of. Based on these two, we may probably pull ahead our capital raising plans or defer our capital raising plans.
So on the ECL front, would you like to throw light? What is your preliminary observation on the same, and how is that notification, if and when implemented, would impact our numbers?
So I think that there's a transcript of yesterday's. RBI had organized a meeting for directors of all private sector banks, and
yes, sir.
Q&A session. And if you go through the transcript, from what we understand, even they are looking at a 3 to 5 year horizon, and beyond that, we won't want to hazard a guess.
So taking into account our book, what should be the impact if that is spread over a period of 3 to 5 years? What should be an annual impact?
So it is. So I wouldn't want to comment on it right now, because there are 2-3 moving aspects within ECL itself on how to recognize whether we'll be completely aligned to global standards or we will have our own parameters. So unless there is ample clarity on the same, I wouldn't want to kind of comment on that right now.
Sir, a small point on the book value and the dividend payout. Firstly, on the book value part, sir, currently also we are, the market is not giving the right valuation. So I think a lot of effort has gone over the last 1.5 years by our early CMD also, and currently also when we will be interacting with the new CMD in the next call. We hope that steps will be taken to increase your stakeholders' value also. We are trading well below even one-time book. I think the 260, 265 is the band, and we are currently at 150 rupees. So there should be a concerted effort wherein value creation for the stakeholders should be the utmost task there.
Yeah. Here we'll hope for the best. There are a couple of aspects. So as you know, this bank does not have any promoter, and institutional holding is around 30%. Retail own around 70%. So some of this is slightly difficult to control. Yeah, but we will continue to deliver good performance, and based on which we hope to see improvement in this aspect as well. And we will rely on your community also to help us in this aspect.
So on the dividend payout, sir, we this time kept the payout ratio lower than what was the payout last year. So if you could give us an understanding of how did we came to that figure of 50%? Last year it was 4 rupees on an EPS of 16 rupees. And this year we have done record profit, and on an EPS of closer to 38 rupees, the payout is 5 rupees per share. So if you could explain to us how did we conclude on this payout, sir?
I'm not sure how to react to this. I thought 5 was a very good number when compared to what's being announced elsewhere. And we were personally very elated at 5. But 5 it is. Let us see how it goes going forward. Yeah, there is always, my colleague is saying, a dil mange more, but we want to be...
but there has to be a formula on the basis of which the dividend distributed to your shareholders. It is not about the dil mange more concept, but there has to be something on the proportionate basis. On EPS of 16, you are distributing 4, and on EPS of 37.66, you are distributing 5. So there has to be some understanding on the basis of which the dividend payout the board have deliberated on.
We showed up on we are also kind of looking at fairly decent capital adequacy norms. We can give out a large pot of dividend, hit the market, raise capital at a discounted rate, then shareholder won't be unhappy on that count as well. So that is why it's a balanced call always, and there is no straight one-line answer to this specific area. We thought that 50% was considering how the balance sheet looked, how do we kind of construct the reserves, what are our growth aspirations, opportunity to raise capital in future, etc. We thought this is and sustainability of the same. We thought this is we arrived at this number, and we have actually received fairly very good favorable feedback from our existing shareholders in this area.
Thank you for all the response, and we hope for continued performance going ahead, because it is the performance that is going to undermine all the principles going ahead. So we hope we look forward that the environment is conducive for us to report these continuous set of growth numbers. That this should be the endeavor. But we hope for that, I think.
Thank you.
So just hi Melissa, so cash with RBI, the interest that we earned was around 1.58 crores. So that's but there's a slightly more complex answer to this. That was on account of various other factors like reverse repo, swap deals, etc. But I hope that answers the question the gentleman raised earlier. So interest on balances with RBI and other banks, 1.58 crores is the number. This was a little muted on account of the 2 points. For some part of the year, we were on the borrowing side, particularly in Q3. Hence, this number looks a little muted vis-a-vis last year.
Thank you, sir. We will move to the next question from the line of Yashwant Kumar Tippeswamy, an investor. Please go ahead.
Yeah, hi. Thanks for the opportunity. Am I audible?
Yeah, Yashwant. Good to hear your voice. You are audible.
Yeah, congratulations, Karnataka Bank team as a whole. It's a great job. And hi, Shekhar, Balchandar, and Gokuldas Pai. So, my first question, I mean, quite a few people have already asked about the growth. We are targeting of more than the industry growth. So I just wanted to getting a little more details with respect to the last 2 months. How has it been? And the next question is on the establishment expenses. So do we foresee that it would continue in coming quarters as well?
So like we said right in the beginning of the call, we've seen green shoots of the changes that we have made in the retail side in these 2 months, and we hope to see the momentum growing. Clearly, there has been heightened activity in gold loans, home loans, and to some extent in the MSME space as well. We have a large agri co-lending model falling in place. We've already dispersed significant amount through that arrangement. We will see a couple of more arrangements coming in place. So we are excited on the opportunity that this presents to us. On the OPEX, we would see an approximate increase of anywhere between 5 to 8% going forward, given that we have to make some provisions in terms of employee cost. We will be opening 50 odd branches. There is a heightened tech investment as well. So if the growth aspirations pan out as per plan, which we are seeing positive signs already, it will be more towards 8%, I would say.
Okay. So the ballpark number is about 50 odd branches in this financial year. Is that what you said? Okay. Perfect. And coming to the other income part of it, so I understand that the strategy is to focus more on retail and gold loan especially. So having said this, I understand that there should be a right balance in improving the other income as well. So are there any thoughts that have gone in on that side?
Yeah, other income we already, so like I said, we did around 1,155.60 crores of other income, excluding trading profits and depreciation. So this is distributed heavily across various heads. There are some heads where we saw good progress, particularly in terms of banking fees and commissions. There are areas where we can do better, that is exchange profit, locker rentals, etc. We also will be focusing more on third-party income, where again we see a large opportunity pan out, particularly with our analytics capability maturing. You clearly see the cross-sell models fall in place. So here also particularly we will see more input. But having said which, thanks to UPI, there are areas like debit card, ATM, where we will see some slowdown, but it will be more than compensated from transaction banking, growth in transaction banking fee income and third-party fee income. Also, we will take tactical calls on areas like locker rentals, etc.
Okay. And I just wanted, this question is like...
lastly, if we see the current trend of interest rates pan out, there will be a write back of MTM depreciation opportunity as well.
Oh, okay. So, this question is exclusively for you because you have joined about 3 months back. So, just wanted to understand, considering the strategy that you've got in, like the retail, increase in the retail portfolio. So, this is referring to 26th slide number, and that is about the NPA breakup. So, I see that the credit portfolio with respect to retail, it says 65%.
Hey, that is out of the kind of total NPA. And here it also includes agri, so that is retail and agri. But this is on the back of what happened over the last 2 years, increase, rising interest rate scenario, the COVID, etc. We will see this moderate out further. A large percentage of this is from the agri side. Almost our retail portfolio is also, the fact remains that 50% of our book is retail. So that, and this is a relatively high yielding book. So while in terms of ratios, this may stand out, but we are monitoring this very closely, and you can be rest assured that this is one area of business which we understand quite well, and which will help us deliver our growth aspirations.
Yeah, I get that, but my question is more of like because we are targeting more of a retail, advances increasing in, right? So my question is more about whether the existing framework works out well with respect to arresting this NPA with respect to retail portfolio, or do you think that there has to be some more additional criteria that needs to be added to the existing framework in order to improvise and decrease or otherwise reduce the contribution from the retail side? That's my question.
So yeah, thanks. So yes, of course, there is always opportunity for improvement. The current so we as the way we are organized is for monitoring our stressed portfolio, for managing our stressed portfolio, we clearly have two largest functions. One is what we call credit monitoring, and the other is recovery, which happens. So we use a fair bit of technology in the credit monitoring department, where we track early warning signs to understand signs of incipient stress, and then take necessary actions, followed by if still the account slips into default or NPA, then we will the credit recovery department kicks into action. Here the good thing is a large part of our loan portfolio existing and the areas that we plan to focus on will be security backed, and hence that gives and these are all bankable securities, and as you have seen in the past, our ability to recover from these loans is fairly good, and this gives us a fair amount of comfort. Also, like we said, we are putting up a full-fledged analytics shop with the help of E&Y. Here we are further enhancing our surveillance and monitoring capabilities using AI, etc. And that will help us identify trends with respect to how our portfolio is behaving.
Okay.
And actually react to the same. Trust, I answered your question in this regard.
Sorry, come again, I didn't get that.
So I said, the last point I said was we are setting up the ACOE, which the Analytics Center of Excellence, who are further strengthening our capability to monitor accounts. They are improving our early warning sign systems. We are enhancing our call center capability to help improve our ability to track and monitor accounts which show signs of incipient stress. A combination of all this and what we are doing already will help us manage whatever NPAs or stressed assets that could come our way.
Okay. Thanks, Shekhar, and thank you, and all the very best.
Thank you. Pleasure having you on our call.
Thank you. We have the next question from the line of Dev Bhattacharya from PNB MetLife India Insurance. Please go ahead.
Yeah, hi Dev. Melissa, before I take Dev's question, I think so you can make an announcement of probably one or two more calls. We're already 1.5 hours into the conversation.
Sure, sir. Thank you. Please go ahead.
Hi Dev.
Yeah, hi. Hello, sir. So just a couple of questions. So one is on the restructured accounts. I just saw that the provision is around 10%. So in your opinion, what could be are we well provided there, or could there be any further slippage, or so just your color on that as well?
So our standard restructured provision is slightly higher. It is in the range of 13%, I would say. We would come back. But clearly, like what we did in the fourth quarter, wherever there is an opportunity to provide more and it is supported by our financial, you take those prudent calls of increasing our provisioning there. Also, like I said, almost close to 90% of the 90% of the restructured book is and customers are repaying those three buckets that I mentioned upon. And right now, I stand corrected. The provisioning is at 10.31%, but we would also see that the book has improved considerably. The restructured book is today at 2,570 crores, of which if we exclude related accounts, it is around 2,070 crores. I would also hand over the phone to my colleague, Mr. Abhishek Bakshi, who would throw more light on the specific aspect.
Yeah, hi. Actually, to highlight you on the numbers, as the size has decreased in this quarter as compared to December, in this quarter we have a reversal of a provision. It is about 25 crores. We have a reversal of the provision.
Okay.
That's another reason why so basically there's been a reversal of provision, which is why this further looks at around 10.31%.
Okay. But looking at the portfolio, you are like kind of okay with that number?
Yeah, we are comfortable at current levels. Yeah.
Okay. Okay. And just a couple of, I think you mentioned that some of the portfolio was like for the low yielding. So was it like more from the large corporate portfolio, which kind of?
It was from the large corporate and PSU portfolio.
Okay. Okay. So going forward, one is on the retail strategy. So from a risk-weighted asset standpoint, would we kind of see an increasing risk on the book, or would you broadly we would be at the same level if we were to increase?
At similar to lower levels, because you also see gold loan playing out and home loans. So we would see this at around current levels to kind of reducing. That's where we are. So it range on between somewhere, if you see the risk-weighted assets, it's around 56,000 crores right now against a December number of 54,000 crores. So it is plus or minus 1,000 crores, depending on. So in terms of percentage, it would more or less be around the same area. Of course, it will grow in tandem with the growth that we demonstrate.
Okay. So broadly, whatever is the overall number for the bank, so the weighted mix of these two would kind of be broadly the same from at an overall bank level.
Yes. Yes.
Right. Okay. Thank you so much.
Thank you.
Yeah.
Thank you. Ladies and gentlemen, we will take one last question from the line of Rakesh Kumar from B&K Securities. Please go ahead.
Thanks, sir, again for the opportunity. I was a little confused when you replied saying that it is on the interbank, some borrowing that we had taken. So in the expense line, in the interest expense lines, do not we include, interbank borrowings and the RBI borrowings number? Or how do we do it? Like we net it off from the, from the income line, or how do we do that? Because there is a separate line item in the interest expense for interbank borrowings.
So hi. My colleague Abhishek will take this question. Over to you, Abhishek.
Yeah, I was answering on the interest income side. So as a majority part of this year, it was on a borrowing side. So it is the income on the TREPs and the overnight the market lending. That is the interest income I was referring to. Interest expenses is accounted for separately under the expenses schedule.
Does this answer your question?
I think we can discuss it separately, sir. I think it is.
You can mail me.
Yeah.
Across, and I'll be replying. Okay.
Sure, sir. Sure.
Thank you.
Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Shekhar Rao, MD and CEO Interim, Karnataka Bank. Closing comments.
Thank you, ladies and gentlemen, for being a part of this call. Thank you, Melissa, for hosting us. It's been a pleasure seeing you and a lot of insightful questions. We hope to build on these. We look forward to more frequent interactions with all of you instead of just this customary call at year end. We once again thank you for your support and your compliments. Good evening, everyone. Thank you.
You are welcome, sir. Ladies and gentlemen, before we conclude, participants can connect with the bank's investor relations team to have any further clarifications not addressed on this call. On behalf of Karnataka Bank, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.